Hello and welcome. Continuing my series of introductory financial modeling through the medium of the ModelOff World Financial Modeling Championships questions. We're up to 2015 now, round one. I'm just, well, I guess a mix of for fun and for logistical necessity. I'm going to try and record a full round in one go today, obviously not including the multiple choice questions because I never do those. But I'm going to be away for a little while over Easter, so rather than just abandon my channel like I pretty much did last summer, I thought I would do a batch prep and leave you with something to mull while I'm gone. So anyway, we got three cases. First one, which I'm going to put up probably Monday I'm away, is this one bread and butter. Then second one for Wednesday is tax, and third one for Friday is options to call. I'll talk through each one of them in its own video. So start with bread and butter. The idea is this is you're applying for a job at a PE firm and they're giving you a kind of basic financial modeling test. So I haven't actually applied for a PE job, so I don't know how close to reality this is, but it's at least kind of styled off the kind of the simple kind of exam that a PE firm might give you. I suspect they'd give you more than 40 minutes to do it, but there you go. So we want to build a three-way integrated financial model. We want a 10-year forecast. Where is it? Yeah, we're given the assumptions in an Excel file plus a template for the balance sheet and the P&L, but no template for the cash flow statement. So equity investment date is the 31st of December 2015, and we want to model the 10 years after that. So year one is 2016, 1st of January to the 31st of December. Year 10 is 2025. Assume all cash flows occur on the final day of the period, so it's obviously relevant when we're going to be doing discounting. Day zero transactions, the initial investment, so you invest 30 million of equity, borrow 20 million of debt, and the balance sheet assets are 3 million of cash, 3 million of accounts receivable, 4 million of inventory, and 40 million of property, plant, and equipment. Then all these assumptions are in the model as well, but I guess let's look through them here. So year one sales are 25 million and they grow annually by the minimum of 3 million or 8%. COGS are 60% of sales. Expenses start off at 3 million and grow by 7% per year. CapEx at the end of year four, we purchase PP&E for 10 million, 90% funded by an equity injection on the same day, with the remainder funded by cash on hand. Depreciation, the original PP&E depreciates over 10 years in a straight line method. The new PP&E depreciates over 5 years in a straight line method. Interest is charged on the outstanding debt at 6.5% per annum, paid at the end of each year. Principal payments are 2.5 million per year until the debt is repaid, made at the end of each year, immediately after interest payments. So again, typical simplifying assumption. The balance stays the same throughout the year, so the interest is just the interest rate times the opening balance, just to keep it simple. Payment terms and working capital. Inventory at the end of each year is 30% of COGS. Accounts receivable is 10% of sales. Accounts payable is 12% of COGS plus 15% of expenses. At the end of each year, any amount above $4 million in the cash account is distributed to equity investors. If there is less than or equal to 4 million, no distributions. Only constrained by cash available, not by book profits. So in other words, if you make a loss but you have cash, you could still pay out cash. All taxes are zero. That's a remarkable simplifying assumption. Okay. No interest is earned or paid on positive or negative cash account balances, and then we get into questions. Okay, so let's hop into the model. So here are the assumptions in the Excel. So we've got our sales, COGS, expenses, opening PP&E, new PP&E, working capital, percentages, debt. There's one here that's left blank, which is the equity injection amount, and for that we just need the total amount times the percent funded by equity, and we're all good. And then we have the opening balance sheet. So I've talked about this before. Oh, actually, sorry. First thing when I get to this sheet, I always remember that Dan Mayo, who I assume wrote this question, has a much bigger screen than I do. So he always has lots of space over on the left-hand side. I don't have as big a screen because I'm working on my laptop. So I'm going to shrink a bunch of these, squeeze it all up a little. There's probably some columns we could do with a few less columns there. Okay. So the first thing I'm going to do is basically set up some plumbing. I've talked about this in another video before, that basically the temptation on a question like this is, first we have assumptions for revenue, then we have assumptions for costs, then we have assumptions for expenses and PP&E and so on, and you kind of build up schedule by schedule, and then at the end you try to plug it all into the balance sheet and you freak out if it doesn't balance. but a much kind of more error tolerant way to do this, in my experience, is to basically build the plumbing first so that you can make sure the balance sheet balances as you layer in each piece, because that way if something goes wrong, you know it's gone wrong in the piece that you just layered in. So what does that mean? Well, sales we're going to model later, COGS, expenses we're going to model later, but EBITDA is just going to be the sum of those three if we do our signs right. In other words, these are going to have a negative sign, but that's fine. Then we take off depreciation and interest to get to our net profit. So again, we just sum the 3 rows above. Then we take off our distribution and get what goes to retained earnings. So again, we just sum those rows above. Simple. Now, for the balance sheet, I will fill in the opening balances. So cash, are these in the same order? Cash, receivables, inventory, PP&E. Looks like they are. So there's the 50 million, and then the debt is here. And I guess the idea is that I'm supposed to uncolor these cells as I go along, fixing them. And I also want to make all of these red because they're different formulas from the rest of the row, so I don't want to be accidentally tempted to copy across like that. Which reminds me that I'm going to hide all these extra columns to make it easier to copy across. Okay, so shareholder capital is going to be that, where is it? Equity injection, 30 million. There we go. And now we've got net assets of 30 million, total equity of 30 million, and our balance sheet balances. And then I'm just going to add a line here for balance check. And I'll just make that round this minus this to, let's say, 6 decimal places, which should be plenty to make sure that we're picking up on any errors. And then here I'm going to have sum of squares of those. And that should be 0. And the way that I like to alert myself if something is wrong is to have an enormous alarming red color take over the header in the event that the balance sheet is ever unbalanced. So in other words, if at some point I'm going along and I accidentally put a 5 in, whoa, the whole thing's going to light up. So that's going to make it really easy to spot if something is wrong. Okay, so now, again, the starting logic for the balance sheet can just be everything carries over, because the idea is in the event of no activity, and we haven't modeled any revenues or costs or anything else, so that is no activity. In the event of no activity, everything carries over. That's like your balance sheet default. So then cash flow statement, we will start with our, what's the easiest to start with? I guess we'll start with our EBITDA. And then we don't need to worry about depreciation, but the equivalent thing that we need to worry about is CapEx. We need to worry about our interest expense. Oops, all right, how did I get up there? Interest. I don't know why it was floating in the wrong place there, but expense, principal, payments, and we need to worry about change in working capital. And there might be other things, and then we'll get to change in cash. So again, right now I'm just putting in plumbing. Nothing is actually being filled in, so I don't need a cash flow for year 0. So my EBITDA. Oh yes, and of course I need my distributions in here as well. But again, if there's anything that I'm missing here, it'll become obvious because the balance sheet will at some point fail to balance, and it'll be easy for me to see what thing I've failed to add in. So right now I'm just setting up the plumbing. So opening cash, closing cash. So the opening cash is just from the balance sheet in the previous period, and the closing cash is the opening plus the change. And then we do our first bit of wiring in here, which is to point this down to there. And as you can see, the balance sheet stays balanced. Everybody's happy. So now we can start making some things happen. So first, let's model sales. So first thing I'm going to do is actually just put in some of these references, some of these cells in a place that I can more easily get at them. So my year 1 sales is 25 million, and my 2 kinds of growth are 3 million or 8%, and it grows at least as much as either of those, so percent 2DP. And then I'm just going to make all of these gray, just as they're my kind of placeholder. So I'm going to go ahead and now. Oh, yeah, sorry. So the other piece of basic plumbing, before anything else, is just to say that, so whatever we get as far as retained earnings, we should carry to retained earnings. And once we've done that, our basic changes up here shouldn't break anything. So I'm going to say that for my first one, and because it's a different formula in the first row, I'm going to make it red, and then I'm going to say, so I think I want it to grow by at least grow by the minimum of 3 million or 8%. So min of this plus 3 million, or this times 1 plus 8%. So in the later years, it'll grow by 3 million. In the earlier years, it'll grow by 8%. Fine. Then my COGS, again, I'll do the same thing here. Just link my 60% there. So minus that times that. Carry across. My expenses, same deal. I've got, got a year one figure, which is here. And I've got a growth figure, which is here. So minus this, and then this times 1 plus this. Okay, happy days. So to get to my depreciation, I'm going to have to do an asset schedule. So let's do that. There's no kind of requirement to produce the schedules in any particular order, but you know, just working down through these in the order they come is as good a way as any to make sure that you don't forget anything. And then at the end, you can always go back here and look if there's anything you've missed. So we're going to have two of these. We're going to have one for opening, PP&E, and then we're going to have one for new PP&E. So we're going to have opening, depreciation, closing. That's all you have for opening PP&E. For new PP&E, we're going to have opening, depreciation, capex, and closing. Okay. So then our closing balance here is going to be this. And again, it's a different formula from the rest, so and then we can say, so you could just say equals minus this. Sorry, again, I'm going to link my assumption into here for ease of reference. Here. So we've got a 10-year useful life. So because you're doing a 10-year model and it has a 10-year useful life, you could just say minus this over this, and it'll work. You know, you get to 0 at the end, but it's a little delicate if you were to extend the model later. So a better way to do it is to say minus the minimum of that and this. And that way, let's say that we did, oops, sorry, some extra there so that we get to 0 at the end. You can see now you're not going to depreciate more than there is. So that's good. And then we can carry all of this down to here and put a bump in the middle. So our new PP&E has a 5-year life. It has a value of 10 million, and the 10 million should be here, and purchase is in year 4. So I'll fix up all these bits that are not working logically in a second, but first it's going to be that times this equals this. So we're locking the row up here, locking the column over here, and need to apply the format. So now you can see we spend our 10 million in year 4, happy days. Then this we'll need to pick up the capex as well, obviously, and this will start out at 0. So then we spend 10 million, and then this obviously we have to fix. So instead of pointing at, the opening balance, it should point at here. we're dividing by the 5-year useful life, which still makes sense, and we're comparing to what's available, which still makes sense. So now, yes, what we should see is we buy it at the end of year 4, and then it's fully depreciated by the end of year 9, nothing left in year 10. Okay, so now, once I put my depreciation in, actually I don't think once I put my depreciation in, it won't break anything immediately, but then I'll have to link it up in a couple of other places. So this plus this. Oh, no, that does break things. Good. Oh yeah, sorry, because I started from EBITDA. Okay, so that means everything's off. Good, because it should be. So then I grab my closing plus closing, carry that across. Everything's still off, but that's okay because we still have to factor things into cash. So let's just say for a second that I forgot about the capex. No, I guess, sorry, that is the only thing for some reason I had in mind that there was another thing to do. But anyway, so what you can see is if I look at my balance, it's balanced for the first 4 years and then it's off by 10 million. That, again, in the context of having just added these two things, it's pretty easy to spot, okay, what's missing is capex. It's the nice thing about doing it this way. It's always easy to spot where something might have gone wrong. So we need a negative sign on this, obviously, because capex is cash out the door, and now we're balanced again, and we've done our asset schedule. Okay, so sorry, I guess I should be uncoloring these as I go. So now we need to do interest, so we'll need a debt schedule. Distributions, we'll have to get to those later because they're a little more complicated, but let's carry on down. So, got an asset schedule, let's get a debt schedule. Debt schedule. Okay, so again, just going to have opening. We don't have any drawdown, right? It's just a one-time. Fine, so opening, payment, closing, interest. So again, I can just point it to what's already on the tab. And my scheduled payment is 2.5 million. And again, I want to take the minimum of that and what's left to pay so that when I get to the end, I don't, keep paying off and go to a negative balance because that doesn't make any sense. So then the interest is the opening balance. Sorry, let's again carry over the interest rate. Okay, so then it's going to be this times this. That's already annual, so I don't even need to adjust, and we're good. So now we bring our interest up here. That will temporarily unbalance us, but fear not, because we also need to bring it into our cash flow. Also with a negative sign. Now we're balanced again. Now we need to bring it into our balance sheet up here. That'll unbalance us again, and then we need to bring in principal payments to the cash flow, and that will rebalance us again. Lovely. Okay, so we keep moving down. Distributions, we will have to finish off our cash to be able to do that. So let's work out receivables, inventory, all that fun stuff. All our working capital. So receivables, 10% of sales. Just going to grab one of these handy dandy percentage formattings. So receivables, inventory, and payables, I think has two kinds. So receivables is 10% of sales. And this. And now we're immediately unbalanced. So before I do anything else, let me just add in my change in working capital calculation. And you can do a quick check here. 500,000 is what we're off by. Cash is too low, so we need 500,000 more cash if you need a kind of sign check there. So that's going to be this minus this, and then we'll have the same direction of the signs for the other asset, and then the opposite direction of the signs for the liabilities. So that, and then it's going to be current year minus prior year. Carry across, and we're back in balance. And this time, when I fill in the other categories, we should not go out of balance at all. So inventory is 30% of COGS. So this times COGS, which is here. Oh, sorry, need a negative sign because COGS has a negative sign, so we got to bring it back to positive. All good. Then payables has two pieces, right? So it's 12% of COGS, 15% of expenses. Oops, wrong way. So 12% of COGS, 15% of expenses. So 12% of COGS, again with a minus sign, and 15% of expenses. Okie doke. Now we've got almost everything done. Our shareholder capital. Oh, yeah, sorry. I put all of the capex as cash out, but of course it's not because we're paying for 90% of it with an equity injection. So let's get our shareholder capital right, and then we will fix that. So I guess the way I'm going to do that is just take this, put it up here. So the amount is 9 million, and the period is 4. So here we're going to say, and again, I'll make this first bit red. So say this plus, oops, plus this. I like times just because I find it easier to read the formula, but if you prefer to use an if statement here to say, you know, if this is equal to that, then do this other thing, that's totally fine as well. So carry across, and we should see, yes, 9 million appears there, and we get out of balance. And that is because, I guess the easiest way to do this is just to say cash capex. And then where do we have the assumption? Here, 90%. So our cash capex is just going to be our capex times 1 minus that 90%. And we're back in balance again. Our retained earnings is already working correctly. So we're almost there now. We just need to figure out distributions. Where's our cash here? So what I'm going to do for that is, oops. So actually, I'm going to take the distributions. Wait, yeah, I'll take the distributions out of here. Change in cash pre-distributions, closing cash pre-distribution. That's just going to be, again, previous period's cash plus change in cash pre-distribution. Then distribution, and then we'll get to closing cash. So let me see, what do I want to say here? I want to say that minus 4 million. Min of, sorry, no, max of this minus the minimum cash, which is over here somewhere. Distribute cash above this level, yes. Max of that and 0. And the closing cash is this plus this. Which is fine, don't sweat it, because we also need to link the distributions in up here. And we're back in balance. So now I'm done with up here, so I can do all the rest down here. I just need to copy across. So copy all that across, and then we just need to do a little sense check to make sure that it is working. So this opening cache I can get rid of. What? said I could get rid of. Where's my Alt-ED? There we go. Okay, so we've got closing cash of 4 million every year. Okay, so we're making lots of money. Hooray. And that's it. So I guess the other thing that we'll naturally want is equity cash flow. So let's say injection, distributions, net CF. So for the injections, I guess I'm going to have to do differences. So I'm just going to do my usual format this as an empty cell not to be screwed around with. And then I'm basically going to take current period's equity minus previous period's equity to figure out my injections, and the distributions we've already figured out. So then we'll be all set. So this minus this, so inject 30 million and then another 9 million in year 4 and then nothing else. And the distributions, I guess, sorry, I should really swap the sign on this. Then the distributions are going to be from up here, wherever I put them here. Some of that carry across. So, yep, getting a very nice return there. All right, so let's answer some questions. I'll pop in a quick Q&A tab. How many questions have we got? Quite a few on this one as far as I remember. 16. Loads and loads and loads. Okay, so 16 to 30. 16 starting at 16. All right, 15. Okay, so question 16. To the nearest $1,000, what is the value of sales in year 3? Okay. 29160, and it is there, and I don't even need to round it to the nearest $1,000 because it already is a multiple of $1,000, so that's B. Nearest $1,000, the value of sales in year 9. So this is just checking that you've correctly switched from one approach to the other. And I guess could just go and manually look it up, but I'll round comma minus 3 to get to the nearest $1,000, 45672, which is D. Question 18, the nearest $1,000 total value of COGS over the 10 years. Here's COGS, here's 10 years. And I'm just going to copy this format down so I don't have to keep screwing around with that. And I'll put a minus sign in front of this. Is this nearest $1,000 as well? Yes, they all are. Fine. $216,051. That's F. Okay, 19. To the nearest 0.1% value of year 7 expenses as a percentage of year 7 sales. So year 7 expenses is here, divided by year 7 sales. And that is 11.35, which is F. Oops. Just lost my keyboard. Now it's got it back. What did I say? F. Okay. 20. The nearest $1,000 total value of interest paid over all 10 years. Down to my debt schedule. And again, we don't need to round it. 5850, which is D. 21. Nearest $1 million book value of PP&E at the end of year 7. So round PP&E. Go up to the balance sheet because that puts them both together. The end of year 7. Oh, again, I don't need to round anything actually because that's already a multiple of $1 million, which I guess the PP&E always is in this model. So that's B. 22. Nearest $1,000 value of inventory at the end of year 5. Inventory year 5 right here, minus 3. 6122, which is F. 23. Value of total assets at the end of year 6. And I guess this is nearest $1,000 again. 36285, which is A. 24 is nearest $1,000 value of accounts payable, year 4. Accounts payable in year 4. 2819, which is C. 25 is nearest $1,000, the value of net profit before distributions in year 9. Net profit before distributions in year 9. Minus 3, 7114, D. 26, nearest $1,000, the value of net cash flow before distributions in year 4. Where's my cash flow here? Change in cash pre-distributions in year, did I say 4? I think I said 4. Yes, 4160, which is C. Yeah. 27, nearest $1,000, total amount of distributions to equity. Oops. Again, the round. You know, obviously, in the exam, you don't actually need to round because you can just look, but 72438. I like to leave the worksheet with the answers actually in there. Nearest $1,000, balance sheet value of total equity at the end of year 10. This is your classic. If everything works, then this will work. So, moment of truth. 13296, 13296, which is B. Looking good. Near 0.1% IRR of equity cash flows using the IRR function. The reason I did not put in a return here is because you never know what return function you're going to be asked to use. Okay, 11.92, that's E. All right, assuming that sales grow by a set percentage year on year rather than the minimum, do not change any other assumptions to the nearest 0.1%. What does the sales growth percentage now need to be in order to achieve an equity IRR of 13%? Okay, that's all right. I'm in the wrong place. Back over here. I think what I'm going to do is just take these, put them over here for a minute. So I want the minimum, smaller of the two. So as long as this is bigger, let's just add a bunch more zeros to this. That means we should always be growing by 8%. Just quickly check that's working. This over this, -1. And we are, yes. So then it's just a question of goal seek. So just link to the IRR. And percent, 2 decimal places. Well, let's give it a few more actually, just to be safe. And goal seek that to 13% by changing sales growth here. That's sort of kind of close, 8.63. I'll take it. I think I'll take it. Let's see, 8.63. Well, I guess the easy way to check is if I go 8.64, whoops, 8.64, that's noticeably over. If I go 8.62, that's noticeably under. 8.63 on the nose, pretty close. Okay, so that is my answer. Now, how would I make this more dynamic? I guess I would say, let's take both of these, put them over here, Q13, and so basically what I'm saying is I'm adding in scenarios here. So Q, or what is it, Q, not 13, Q30, scenario active. I'll make that false. And then we'll say if, whoops, if this, then this, otherwise this. Get rid of that. Get rid of all this. And Q30 base. Just make that true. That's your 8.63, which is E. Activate Q30 scenario for this one. And then we'll just have a hard code. And then we'll turn off that scenario to get the right answers for all the rest. Again, you don't really need to do this in the exam, but I like to leave a model behind that can handle this stuff. All right, that's what I got for that one. So let's see, I've saved a few minutes versus the 40-minute target. So I'm going to save that, close that, and go right on to the next one. But I guess you won't see that for another couple of days, so see you next time.